Asset classes and diversification. At a very broad level, the basic asset classes are cash, equity and fixed income. These categories have also expanded to include commodities and real estate. Equity generates growth. Debt generates income. Cash is for parking funds and earning a nominal income. Asset class refers to a set of investment options with conceptually similar risk-return features. The sources of risk and factors affecting return are similar for all investment options within an asset class. They tend to exhibit a high level of correlation in returns. Each asset class is subject to different risk factors. Equity has market and business risks. Debt has inflation, credit and reinvestment risks. Cash has low risk. Commodities have cyclical and demand-supply risk, and real estate, gold and currency are vulnerable to economic cycle risks. The required rate of return from any asset includes risk-free rate of return, inflation premium and risk premium. Cash equivalents need to compensate for the inflation, debt securities need to compensate for default and reinvestment risk, and equity securities for business and economic risks. Market capitalization-based categorization of equity is common, since liquidity, risk and return are impacted by size. Operational risk factors vary across industry sectors, leading to sector-based categories. Investment styles have led to categorization as growth, value and momentum stocks. Longer tenor bonds have a higher interest rate risk and tend to be categorized separate from short tenor bonds. Government securities, given their credit risk-free character, form a separate category, so also do high-yield or junk bonds that have a high credit risk. Municipalities, corporates, government institutions are all different for the nature of borrowing and structure of their instruments. Within each asset class, there can be subcategories. While each of these categories are impacted by the same broad factors, there can be nuances which differentiate the returns and risk and create possibilities to benefit from diversification. The risk-return trade-off refers to the need for bearing higher risk in order to earn a higher return. We see that the risk in debt is lower than it is for equity, while equity also provides a higher return. We also notice that mid-cap equity has higher risk than large-cap equity. If two series of data tend to move up and down together, they are correlated. A correlation coefficient of +1 means that the two series move in the same direction all or most of the time. A correlation coefficient of 0 means the two series show no co-movement at all. A correlation coefficient of -1 means that the two series move in the opposite direction all or most of the time. The co-movement is only indicative of common underlying factors, and not dependency. Investing across asset classes provides the benefit of reducing risk. This is because asset classes in themselves may be risky, but since they are affected differently by different factors, they do not move together. They cancel out the risks of one another to some extent, creating a benefit of lower overall risk, called the diversification benefit. Diversification can help bring down the overall risk of the portfolio as it reduces the unsystematic risk which is due to company-specific factors. For example, if you see a diversified portfolio equally weighted in Sensex, mid-cap equity, small-cap equity, long-term bonds, bank deposits, gold and real estate offers a stable and moderate return. Diversification does not eliminate risk or guarantee a return, it reduces the volatility in the returns of a portfolio. No matter how widely diversified a portfolio, the risk can never be eliminated entirely. At times, too much of a good thing can yield undesirable results. Piling a large number of stocks and mutual funds may do more harm to the portfolio than good. The following are examples of applying diversification strategies to achieve a better risk-adjusted return in an investment portfolio. 5 to 7 funds and 10 to 20 stocks is the threshold level of desirable diversification. Beyond this, it is likely that the aggregate return on the entire equity holding will mimic the market averages. Sector funds of every sector or multiple large growth funds simply won't diversify a portfolio the same way owning one large blend fund and one small value fund and one small growth fund would.